Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now to this episode's lecture: non-current assets held for sale and discontinued operations, IFRS 5. Now the objective is to require entities to disclose information about operations which have been discontinued during the accounting period. It is also to improve the reader's ability to interpret the results and to make meaningful projections. Now we'll first deal with held for sale. An item held for sale is a non-current asset or a disposal group of which its carrying amount will be recovered principally through sale rather than continuing usage. So a non-current asset, as you already know, is an economic resource that an entity controls, which will lead to an inflow of benefits. The benefit can be an increase in revenue or a decrease in cost. A disposal group, on the other hand, is a group of assets, possibly net of related liabilities, which an entity intends to dispose of in a single transaction. Now, for an asset or a disposal group to be held for sale, it must have the following criteria. First, the asset must be available for immediate sale. And secondly, the sale must be highly probable. So, for a sale to be highly probable, management must be committed to a plan to sell the asset off. 2. There must be an active program to locate a buyer and complete the plan that has already been started. Thirdly, the asset must be actively marketed at a price that is reasonable in relation to its current fair value. Fourthly, the sale should be expected to take place within 12 months from the date of classification as held for sale. And lastly, it should be unlikely that significant changes to the plan will be made or that the plan will be withdrawn. So let's take a look at the accounting treatment for initial classification. An asset held for sale is valued at the lower of the carrying value or fair value less cost to sell. Any reduction in value is recorded as an impairment through profit or loss. That is, if the carrying value is more than the fair value less cost to sell. So immediately before the initial classification, the carrying amount of the asset must be measured. Now, under cost model, it will readily available as the asset is always kept in the financial statement at the net of the original cost and the accumulated depreciation. However, under the revaluation model, the asset or disposal group must be immediately revalued to its fair value prior to the classification before the comparison can be done. Now, once classified, a non-current asset or disposal group held for sale will no longer be depreciated. It will be presented separately in the statement of financial position. Then the subsequent sale of the asset will give rise to profit or loss on disposal to be recorded in the statement of profit or loss. Now let's test our understanding. Adepa bought an asset at a cost of $100,000 on 1st January 2015 and depreciated its straight line over 10 years. Now the asset's residual value is nil and depreciation is charged pro rata. Now on 30th June 2020, Adepa classified the asset as a non-current asset held for sale in accordance with the rules of IFRS 5. At that date, the fair value of the asset was $50,000 and the cost to sell was $6,000. The asset had not been sold by 31st December 2020 reporting date. So we have to prepare the extract from the financial statement for the year ended 31st December 2020. So we start with the statement of profit or loss. We bring in the depreciation for the year 2020, which is $5,000. If you look at the bottom workings done there, depreciation for a year is $10,000. But for 2020, the asset stayed till half of the year. So we only charge half to the account. Now, for the impairment, we have to first calculate the carrying value. The cost of the asset is $100,000. Accumulated depreciation is $55,000, which is $10,000 for the 5 years from 2015 to 2019. Then half of it, which is $5,000 for the 2020, giving $55,000. It will lead to a carrying value of $45,000. When we move to the fair value less cost to sell, the fair value as stated in the question is $50,000. The cost to sell is $6,000, providing the fair value less cost to sell of $44,000. When you compare the two, the fair value is the lower, so there is an impairment of $1,000. So we charge it to the statement of profit or loss. When we come to the statement of financial position, we record the 44,000, which is the fair value of the asset, and a non-current asset under the heading held for sale separately from the other non-current assets. Now that we are done with held for sale, we move on to discuss discontinued operations. Now, a discontinued operation is a component of an entity that is either being held for sale or has been disposed of. Now, a component is a separate major line of business or a geographical area of operations, or part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations. Or lastly, a subsidiary acquired exclusively with a view to resale, and the disposal involves loss of control. Now, a discontinued operation will exist if 1. Resulting elimination. Now, this is where the disposal transaction results in the operations and cash flow of the components being eliminated from the company's operations. Secondly, continuing involvement. No significant continuing involvement by the company in the operation of the component will transpire once the disposal transaction has been completed. Continuing involvement implies the ability to influence the operating or financial policies of the disposed components. Okay, let's take a look at illustrations to better understand the determination of discontinued operation. General Industries plans to cancel one of its pressurized container products due to lack of sales. The product is part of a larger product group for which cash flows are tracked. So since General does not track cash flows at the individual product level, there is no need to classify the operations related to the single product as a discontinued operation. Secondly, upon further consideration, General decides to list the entire container product group for sale. So, since cash flows are associated with this larger group and it is tracked at that point together, General should classify it as a discontinued operation. Thirdly, General sells one of its retail stores to a distributor and enters into an agreement to sell goods to the new owner of the store. The result will be that the majority of cash flows will continue from the store despite the change in ownership. General still maintains control and influences the operations of the component. It also receives majority of the cash flow from the component. So in this case, it is not appropriate to classify the store as a discontinued operation. There is no resulting elimination and there is also continuing involvement. Lastly, General sells one of its product lines. Part of the sale agreement stipulates that the buyer will pay General a 5% royalty on any sales related to the product line for the next 3 years. General will have no continuing operational involvement in the product line. So as seen, General will have no significant continuing involvement and the resulting cash flow are indirect. So the product line should be disclosed as a discontinued operation. Let's look at accounting treatment for discontinued operation. Now here, we have to disclose the results from discontinued operations on the income statement or in accompanying notes. So the components of this disclosure are the profit or loss from the discontinued operations and the gain or loss from disposing the discontinued operations. Okay. So you first calculate the profit or loss after tax from the discontinued operation, which is equal to revenue less expenses and tax. Then you determine the gains or loss from the disposal of the discontinued operations, or if the disposal occurred within the financial year. You add the profit or loss to the gain or loss on disposal. Then you create a section titled Discontinued Operations on the income statement and record the resulting addition. This should come after the continuing operations section. Also, the net cash flows attributable to operating, investing, and financing activities is separately presented on the face of the statement of cash flow or disclosed in the notes. It's left to the discretion of the preparer. Lastly, if an entity ceases to classify a component as held for sale, the result of that component previously presented in discontinued operations must be reclassified and included in income from continuing operations for all the periods previously presented. So let's look at an illustration of discontinued operations again. So Kozak's car manufacturing operation has been making substantial losses. Following a meeting of the board of directors, it was decided to close down the car manufacturing operations on 31st March 2016. Now the company's reporting date is 31st December and the car manufacturing operations is treated as a separate operating segment. Now explain how the decision to close the car manufacturing operations should be treated in the financial statement for the year ending 31st December 2015 and 2016. Now, for 31st December 2015, the operation is not being sold off, so it cannot be classified as held for sale. Neither is it a discontinued operation, as there is no resulting elimination. The component is still in existence as at the end of the year. COSAC is firmly committed to the closure, but it hasn't taken place yet, so it will be included in the continuing operations. So a disclosure here will be needed in the notes to indicate the intention to close down the operations in the following year. For 2016, the operation can now be classified as a discontinued operation, as it has now ceased operating. Let's test our understanding. So Coffee Co. statement of profit or loss and other comprehensive income for the year ended 31st December 2017 is listed here. We have for 2017 and 2016. So we have revenue, we have cost of sales leading to gross profit, we have distribution cost, administrative expenses, then we have the profits from operations. So this is for the entire activity of Coffee Co. So during the year, the entity ran down a material business operation with all activities ceasing on 30th March 2017. Now the result of the operation for 2017 and 2016 were as follows. Revenue for 2017 and 2016 are here. Cost of sales is also here. We have the distribution cost, administrative expenses. Then we have loss from operations. Now the entity made gains of $7,000 on the disposal of non-current assets of the discontinued operations. Now this has been netted off against administrative expenses. So we have to prepare the statement of profit or loss and other comprehensive income for the year ended 31st December 2017 for Coffee Co. So here, when we come to the statement of profit or loss and comprehensive income, we pick the general figures, then we deduct that for the business operating segment, which has ceased to operate. So for the revenue, we pick the 700, then we less the 60 from it, giving us 640. We do same for 2016. The cost of sales, we pick for the general and we less that for the discontinued operations, which will lead to a gross profit. Administrative expenses, we less the two. We come to distribution cost, we do same. Then we get profit from continuing operations, the one that has not ceased. It is 233,000 for 2017 and 161,000 for 2016. Then we present the result of the discontinued operations. It was a loss for 2017 of 3,000, 2016 of 1,000, which will lead to the profit for the year of 230,000 for 2017 and 160,000 for 2016. Now, if you check the two, it is the same profit that was arrived at, but the presentation now has differed. That is how you treat discontinued operations in the financial statements. So, folks, this is where we are going to draw down the curtain on our discussion. If you have any questions or you have anything that needs clarification, you have any feedback for us, do not hesitate to put them in the comment section below and it will be gladly addressed. Whilst at that, subscribe to our channel if you haven't. Click on the notification bell by it to be abreast with videos when they do come up, and share. Till we come your way again by way of tutorials on the go. Take care of yourself and stay blessed. Poker.